real common question that I get both from our investors as well as borrowers, but typically our investors is, where do we see interest rates going? And I always like talking about interest rates. I started my career as a 30-year bond trader in Chicago, and all I did was live and breathe interest rates every day, every second. I expect interest rates in the near term to go down a little bit more. They have come back. I mean, they went really low maybe 4 to 6 weeks ago. But I think overall, I think we're going to see rates fall a little bit over the next quarter or two. And I would think that they would stabilize pretty good in there for a while. And that's not just my opinion. That would be sort of, I would say, what the market is projecting at this point. And so that always leads to the question of, well, if rates don't go down, what happens if rates go up? And that's actually a more interesting question, because it's exactly what the opposite of what most people feel is going to happen. And so if you saw rates going up, I think you'd see a little shock to the economy. I think that asset pricing in general would drop a bit. I think it would definitely send a shockwave through the stock market. I think you'd see some stocks drop in prices. I think you'd see some asset values drop, and that's not to say that this would be some kind of panic situation, some large correction. But I just think in general you would see asset pricing drop a bit, and I think banks would become because of that, there would be sort of a pause. I mean, banks have a different role than what we do here at Rubicon, and so you would probably see them step back a little bit, pause, see exactly how much of a drop in the market we're going to have, and then once things sort of stabilize, get back to sort of business as usual. That would be a banker's approach. So if that were to happen, if rates were to go up, that would create some real short-term opportunities for Rubicon as the banks are sort of stepping back and taking note of what's happening in the marketplace. We would be in there actively lending money, and eventually these banks would come back in the marketplace and take us out a lot of these short-term loans. And in general, as we'd be receiving payoffs, because again, as Doug touched on earlier, our average loan is usually 1 to 2 years. Let's call it 18 months. Our average payoff or turnaround on a loan is 14 months. And so with 14 months at relatively 100 loans, we're getting roughly 7 payoffs a month. And so when payoffs come in, we would be getting that money back and relending it back out at slightly higher pricing. And so you, as an investor in our fund, if interest rates were to rise, there would be a slight lag effect as we would be replacing, let's say, old pricing with new pricing. And so as an investor, it would be a good thing. You'd see returns come up a bit. And of course, the trick is how much does asset value get hit, and what kind of risk does that put our overall portfolio in? And given how we underwrite and how important, we'll get to it later, loan to value, loan to cost is to us, we've got some space in there for market fluctuation. Real quickly, I mean, there's some different types of loans that we see pretty often, and then you can, in the little overhead that you're looking at there, you see a market up, market down. And what I'll kind of do with this a little bit, I'll go through it pretty quickly, is talk about the different types of private loans that we see frequently, and market up, market down, when would we likely see those? And so cash out investments, quite frankly, we would see that both if the market were to go up or down. That would be people always need money for all sorts of reasons. 1031 exchange, reverse exchanges would definitely be happening in a market up situation. People are having a hard time finding properties that they want to trade into. So it's easier for them to, before they sell their property, they want to identify one they want to purchase because they're so concerned about it. So in a reverse exchange situation, those typically happen in up markets. Bridge loans, again, for residential properties, those typically happen in up markets. People are worried about not being able to come in all cash or easy close, and they're willing to sort of buy one property before they've sold their own property. So again, you typically see that more in an up market. Business acquisition, I mean, honestly, that could be both directions. I mean, times are good, people are looking to expand, and if you're cash rich and times are bad, it's a wonderful time to expand your business. So those happen in both markets. Construction loans typically happen in up markets. People aren't generally building a bunch of stuff, at least from a speculative perspective, unless they feel that the markets are at least stable, if not going up. Multi-family projects would be in both markets. Non-owner occupied projects. If it's spec, it would be in an up market. If it's a built-to-suit or building someone's house for themselves, quite frankly, it could be in either market. And then fix and flip would typically be in an up market.
Right. I think one other point we should bring up is that our rates and fees aren't driven by any indices or any LIBOR or 10th district treasuries. Vance and I make the decision on what we will structure, how the loan will be structured based on a lot of criteria, and it's a case-by-case basis. So in an up market, Rubicon can thrive because money's coming back into the market, there's acquisitions being made, people need to move quickly, and as he just described in a whole litany of different types of scenarios. And in a down market, banks get much more conservative, and Rubicon finds themselves seeing more opportunities when banks are tightening their parameters for borrowers too. So it's really, again, goes back to us in our underwriting, making those decisions.